Welcome to This Explainer. Today, we're diving into something that kind of challenges everything we thought we knew about investing. We're looking at the myth of the perfect market and a persistent financial anomaly, a glitch, really, that completely flips the script. Let's just jump right in.
So we got to start with the ultimate financial question, right? Can anyone actually beat the market? I mean, we're talking about everyday people or even highly paid, seasoned professionals who literally have massive armies of analysts at their disposal. Can they truly outsmart the stock market over a long period of time? Honestly, it's the multi-trillion-dollar question driving the entire active asset management industry.
Well, to answer that, we need to look at some pretty sobering reality from the SPIV data. This tracks how actively managed funds perform against their passive benchmarks. And wow, over a 15-year period ending in 2016, a staggering 92.15% of large-cap active managers completely failed to beat those benchmarks. Just think about that for a second. These are the smartest folks in the room, right? They dedicate their entire careers to picking winning stocks, yet more than 9 out of 10 of them would have been better off just buying a passive index fund and going to the beach.
To really drive this point home about the failure of active management, listen to this devastating quote from academic Martin Gruber. He famously said, "I can't find any class of investors that earn positive alpha." Alpha, of course, being that elusive excess return above the market average. So whether we're looking at mutual funds, pension funds, or individual accounts, the data consistently shows that, as a group, they just do not beat the benchmark after you account for fees.
Now, if the pros can't pull it off, what about everyday investors trading from their laptops? Well, studies show they actually fare even worse. Individual active traders underperform the market index by an average of 6.5% annually. Why? Mostly because they trade way too frequently, they rack up high transaction costs, suffer from, let's face it, terrible market timing, and generally let their emotions drive their decisions. I mean, we've all been there, right?
Looking at all this data, the efficient market hypothesis seems, well, absolutely ironclad. This theory essentially tells us that stock prices perfectly and instantly reflect all available information. Boom, right away. Under this assumption, trying to find a mispriced stock is literally like trying to find a needle in a haystack, where the needle doesn't even exist. So the logical takeaway for you and me? Passive index funds are pretty much the only rational choice.
But wait, what if the market has a blind spot? What if the so-called perfect market actually makes predictable, recurring mistakes? You see, if the market is perfectly efficient, all new info should be priced in immediately. However, financial historians and academics have found a crack in this flawless facade, a phenomenon that proves the market absolutely does not digest information as perfectly as we're told.
Enter post-earnings announcement drift, or PAAD. This is basically a massive glitch in the matrix. It was first discovered way back in 1968 by researchers Ball and Brown. By definition, PAAD is the tendency for a stock's returns to drift in the direction of an earnings surprise for several weeks or even months following an earnings announcement. So if a company reports a massive positive earnings surprise, the stock price jumps, sure, but then it just keeps drifting upward for up to 60 days. And if the news is bad, it slowly drifts downward.
Let's map this out so you can really picture it. Day 0 brings the earnings surprise. For the next 3 days, we see the immediate market reaction. But here is exactly where the efficient market theory totally breaks down. Over the next 1 to 12 weeks, the price continues this slow-moving upward or downward drift. The market simply fails to digest all the news immediately. It takes weeks, literally weeks, for investors to fully process the implications of what was just reported.
And what's truly staggering here is that researchers Bernard and Thomas found that 25 to 30% of this total delay drift happens in highly concentrated 3-day windows surrounding the subsequent quarterly earnings announcements. Put simply, the market is so incredibly slow to catch on that a huge chunk of the price correction doesn't even happen until the company is practically reporting its next batch of earnings. Crazy, right?
So this obviously brings us to a major question. Why does this slow-moving train happen in the first place? If investors know about this drift, why on earth do they leave this money on the table instead of pricing the earnings surprise in immediately on day 1? In a hyper-competitive financial world, anomalies like this aren't supposed to survive a week, let alone decades.
Well, the academic world is essentially split into 2 main camps to explain this. On one side, we've got risk-based explanations. These folks argue the market is actually still rational, and the drift is just a premium compensating investors for bearing hidden risks, things like inflation risk or liquidity risk. But on the other side, we have the mispricing camp. They argue that it's an irrational delay caused by limits to arbitrage and human behavioral biases. People just systematically underreact to the true weight of the news.
The mispricing theory points to very real market frictions that stop rapid price adjustments. We're talking about things like high bid-ask spreads and low trading volume, which make it expensive and honestly really difficult to exploit the anomaly. Interestingly, the data shows that zero-leverage firms, so companies with absolutely no debt, exhibit much stronger drift effects. Why? Because they face greater information asymmetry. With fewer debt analysts scrutinizing every move, the market is even slower to figure them out.
Another massive friction is the delayed disclosure impact. Think about it. When a company announces its earnings but actively withholds the complete, detailed financials until its formal 10-Q filing days later, analysts are kind of left in the dark. Because they lack the full picture, they underreact initially. As researchers point out, opportunity knocks but once. Firms have this special window to convey value during earnings when attention is at its absolute highest. Delaying the details? That just guarantees a prolonged price drift.
Okay, so here's the absolutely crucial point: the historical potential of this anomaly. Because of this slow market reaction, trading strategies based on going long on positive surprises and shorting negative surprises have historically been a total goldmine. Previous studies have documented annualized returns from PAAD strategies reaching up to an astonishing 43.08%. That is a massive, market-crushing excess return built entirely on the market's sluggishness.
But hey, before you quit your day job to go build a trading algorithm, we really need to talk about the reality of modern markets. We are currently looking at the disappearing glitch. As markets evolve, technology improves, and these anomalies get published in academic journals for everyone to read, this historically lucrative strategy is actively fading away.
Just look at how the return spread between high and low surprise portfolios has shrunk. Back in the 1980s and 90s, you could easily capture a 5% spread. But by the late 2010s, that margin had compressed to 3%, maybe even lower. The easy money that used to just sit on the table has been largely scooped up.
So why exactly is this magnitude declining so sharply? Well, a few reasons. First, increased liquidity means sophisticated arbitrage investors can trade the signal really aggressively, which closes the gap much faster. Second, there's declining earnings persistence. A good quarter today just doesn't guarantee a good quarter tomorrow quite like it used to. And finally, regulations like the Sarbanes-Oxley Act have seriously increased confidence in initial financial reports. That leads to much faster market reactions right out of the gate.
Now, tracking these shifting dynamics requires some seriously rigorous analysis. Advanced academic research, like the studies emerging from executive doctorate and business administration programs, proves that this isn't just a static event. It's an ongoing arms race to find exactly where the remaining inefficiencies are hiding as the market continuously adapts.
And guess what? That arms race has officially entered the realm of artificial intelligence. Modern traders aren't just staring at spreadsheets anymore. Recent research shows traders using AI to literally read earnings charts visually. Step 1. They convert historical earnings data into visual bar chart images. Step 2. They employ convolutional neural networks, deep learning AI, to analyze those images. Step 3. The AI extracts predictive features to squeeze out the final drops of excess return. They're essentially front-running whatever tiny bit of drift is left.
All of this brings us to a really fascinating crossroads for your own understanding of the financial world. We started with the premise that beating the market is nearly impossible for most, yet we saw that a massive glitch existed for decades just because of human limitations. But today, as AI and deep learning systematically hunt down and close these final loopholes at lightning speed, is the perfectly efficient market finally here? It's definitely something every investor needs to ask themselves. Thanks so much for joining me on this explainer, and remember to always keep questioning the data.